Insurance products such as life insurance and annuities can provide tax advantage investment returns. And here to talk with me about that is Michael Finke from the American College. Michael, welcome.
Thank you, Bob. Good to be
So
here.
you recently gave a presentation at the AICPA Engage conference about this very topic, where you're going to have you walk us through what we need to know.
Yeah, I think a good way to think about this is that we need to disaggregate investments from insurance products. Now, insurance products, they're referred to as a wrapper around different types of investments. And there's two primary types of insurance products that we're talking about here: life insurance and annuities. I'm going to focus on annuities because they're really the simplest form of insurance wrapper. You can essentially put an investment house it within an annuity wrapper and be subject to a different set of taxes than if you held that investment outside of the annuity, just in a fully taxable account. So can think of the wrapper as a way of housing some type of an investment. And you can either house risky assets like stocks, or you can house safer assets like bonds and CDs and money markets within an annuity type of structure. And in the presentation, I discussed how especially those tax disadvantaged types of investments, those bond-like types of investments, are more effective when you hold them within an annuity wrapper, or can be more effective.
So you also talked about more about the tax benefits of an annuity in particular, offering, among other things, tax-deferred growth.
Yeah, and let's think about many people are near retirement. So they're, let's say, late 50s, early 60s. They have a lot of money sitting around in their taxable accounts. Maybe a lot of it is invested in CDs or money markets. And they're not going to be using that money over the next 5 years or 10 years. So what should they do with that? What kind of an investment should they hold it in? They want to invest it in something safe. But they also want to have the most amount of money that they can to spend in retirement. So there's really three reasons why an annuity wrapper can be more efficient. The first of all, you're not taxed on growth every year. And what that means is if you invest, say, $100,000 in some very simple type of annuity structure, something like what's known as a multi-year guaranteed annuity. That's a substitute for something like a CD. It provides a fixed rate of return every year. They could be maybe 2%. And in many cases, MYGA returns are higher than they are for CDs. So that's an additional advantage. But when you get that 2% growth, your $100,000 turns into $102,000. But then the next year, it grows by $102,000 times 2%. So you're getting a deferral compounding bonus in your investments. Whereas if it were in a CD, you'd earn $2,000 if you paid 40% income taxes, combined state and federal, then you would only have $1,200 that could grow the next year. So you get a deferral bonus, and that can be relatively modest, let's say as much as 11 basis points per year, if your tax rate today and your tax rate in the future is exactly the same. But if your tax rate is not the same, then you can get a significant tax advantage because your tax rate on growth in your CDs is higher during your working years than it is in retirement, which means that you're going to pay more in taxes during your working years. But if you can put it into an annuity, you only pay taxes when you withdraw the money from the annuity, when it matures in, say, 10 years. At that point, you can pull the money out, and let's say your tax rate is 25%. You can get an additional after-tax investment bonus through what's known as differential marginal tax rates. And that, I think, is especially for near retirees, something to consider with your non-tax or with your fully taxable investment, with your non-qualified investment. Are you expecting to have a lower marginal tax rate, say, between when you retire and age 72 or maybe 73, when required minimum distributions start kicking in? There is a period there where you can start taking income potentially at a lower tax rate. And remember that say 20, 24% tax rate, those are relatively broad marginal tax rates, and it can be attractive to take income at those rates after you retire. Maybe you even have a lower tax rate than that. So that's an additional source of benefit. The third benefit from taxation is through what's known as annuitization. Now, I know that can be very confusing, that an annuity is the wrapper where you hold your investment. but you can choose at retirement to annuitize your savings. What does annuitization mean? Well, that means that you can buy lifetime income from that savings. And with that lifetime income, if you buy true lifetime income through, say, an income annuity, what you can get is additional tax deferral benefit through what's known as an exclusion ratio. An exclusion ratio means that even though you might have accumulated $150,000 by the time you hit age 67 and you begin the annuity, you don't have to pay tax on $150,000 times 2% growth every year. It's only a small portion of that annuity payment that's fully taxable. And so what that means is you can actually defer the taxation for an extended period of time up to your expected lifespan, or at least what the IRS expects your lifespan to be. So that's an additional tax deferral benefit. So just speaking of comparing A versus B, A, keep the money in CDs, get taxed on it every year, versus B, putting it into something like a multi-year guaranteed annuity. And of course, pay attention to the credit rating of the insurance company, make sure that it's a safe company. They are backed by state guarantees, but it's not backed by the federal government. But you can get probably a higher rate of return than you're going to get from CDs. You can take advantage of those two forms of benefit, that differential tax rate benefit, or even better, turn it into a lifetime income. And essentially what it means is that you get more spending in retirement from the safe savings that you have today in a taxable account.
Mm. So I guess two questions. There's always a lot of debate around asset location, and a lot of debate about what investments should go in a Roth, what investments should go in a traditional IRA, what should go in a taxable. Now add to it the possibility that you need to think about what investments go in a annuity in addition to all those other types of accounts.
That's right. And this is related to a concept that's known as basis assets. So basis assets are any type of an asset where you were only taxed on the gain above what you paid for it. Insurance products are a special type of basis assets. Lots of basis assets, for example, an ETF that you might invest in, you are only taxed at the capital gains rate. So those can be very attractive when held within a taxable account. An insurance product, you're going to be taxed at your ordinary income rate, which can be higher than that capital gains rate. So when you're looking to stuff some kind of an investment inside an annuity wrapper, you don't want to stuff your most tax efficient investments within an annuity wrapper. You want to put those higher yield, less tax efficient types of investments. And I like to say that in many cases, the general account of an insurance company, there was a great article in the Wall Street Journal a couple of weeks ago that compared rates of returns in general accounts of insurance companies, and they range between, say, 4 and 4.5%, which is higher than what you're going to get on a lot of bond-like fixed income investments. If you can get that within a product that provides a tax deferral benefit, there was recently a commercial for Guinness beer where they said, it only has 124 calories, but not on purpose. And I think that in many cases, insurance products that generate growth, and this can include life insurance and annuities, they generate growth based on the general account portfolio of the insurance companies. That's exactly the type of asset that you want to house within the insurance wrapper. So it's accidentally the most efficient type of asset. Now, the insurance company invests in those types of assets because they have to meet fixed obligations in the future. They have to pay claims on life insurance policies, and they have to pay income on annuities. So they invest in safe assets, but they try to maximize the yield on those assets by investing in less liquid or longer duration, or optimizing the credit quality of that bond portfolio. And that's exactly the type of thing that you should have within an insurance structure.
So this might be a conversation for another day, but there are all kinds of annuities, right? Variable, fixed, registered index linked annuities, et cetera, the MIGAs that you mentioned. Any thoughts broadly around what people should think about when they think about annuities?
Well, just generally speaking, if you want the asset to serve a purpose, a goal for you. And if the goal is to fund income in retirement, say in a non-qualified, in a fully taxable account, then pay a lot of attention to things like asset location. If your goal is, if you're investing, say, in an IRA, then your goal is to generate as much income as possible. And one of the biggest advantages of annuities within an IRA is that they protect you against the possibility of outliving savings. And we actually did a study recently. We found that people who had that type of asset, a lifetime income type of asset, consistently spent significantly more than those who had the money simply in investments. Because if you have investments, then oftentimes you're reticent about spending the money down because you're fearful that it might run out if you live too long or if you get a bad sequence of investment returns. So having that lifetime income guarantee can actually give people a license to spend to actually live better. Outside of that potential tax benefit, within an IRA, it's giving you the ability to spend more of those savings without the fear that many investors have that they might run out.
Yeah. So anything that we haven't touched upon that you want to make mention of, or anything that you've already touched upon that you might want to reemphasize?
No, but I think one of the most important things to remember when you're investing in anything is that you have to pay attention to, first of all, credit quality, and second of all, how much you're paying for that. So that wrapper may have a cost, and there are opportunities to get that wrapper at a very reasonable cost. There are some that are more expensive. So you have to pay attention to what it is that you're paying for and whether or not you're receiving enough benefit to justify that expense.
So I know we could talk for hours, Michael, but I'm going to leave it here. Thanks ever so much for sharing your knowledge and wisdom as always.
My pleasure.